Everything is more expensive than it was a year ago, housing included. Many believe that we are in a real estate bubble, and the charts are pretty convincing. Take this all-time house price index chart for example. As you can see, house prices have absolutely surged in the past few years. Prices seem to have gone nuclear in 2020, but are now slowing down, and although recent stats have shown a slowdown, this doesn't mean that houses will become any less expensive. There are three main factors that affect housing prices. This includes supply and demand, mortgage rates, and the overall economy. Let's see how each of these are currently affecting the real estate market, and how they will continue to affect it in the future. Let's start with supply and demand. Just as with any other good or service, when the demand of housing lowers, but supply stays the same, prices go down. At the beginning of 2020, new home sales quickly dropped but then increased faster than ever, before dropping again. Now, new home sales are lower than they were before the pandemic. This is consistent with what we saw during the 2008 Great Recession as well. This shows that not only is the demand going down, but it is dropping dramatically. As far as supply, it started out the same as demand with a quick drop at the beginning of 2020, followed by a swift increase to near record levels. The only difference is that the number of building permits have stayed at their high levels, suggesting that supply is staying high, while demand is lowering. So as far as supply and demand, this metric is suggesting that house prices will start to drop in the near future. Metric number 2 is mortgage rates. When mortgage rates are low, home prices tend to rise. Low interest rates tend to attract buyers and therefore increase demand. Low interest rates also enable buyers to purchase a home that might have previously been out of their budget during times of higher interest rates. Since the beginning of 2022, mortgage rates have been increasing rapidly and show no sign of slowing down. In fact, Jerome Powell just recently announced that the Fed will most likely continue to raise interest rates through 2023, and until inflation lowers back down to 2%. Because mortgage rates appear to only be increasing in the near future, this metric is suggesting that house prices will start to go down. That leaves us with our last metric, the economy. When the economy is strong, and unemployment is down, housing prices tend to rise. This is exactly what we have been seeing since after the pandemic. Once stores opened back up and our employment as well as overall economy rebounded, housing prices surged. Unemployment surged during the pandemic but then dropped nearly as quick as it rose, and now currently sits at 3.5%, just 0.3% away from its pre-pandemic low. On top of employment recovering, average hourly wages have grown 15% since the beginning of 2020. Based on both less people being unemployed, and workers making more money on average, this metric is suggesting that house prices will go up in the near future. 2 out of 3 of our key metrics are showing signs of a future decrease in house prices, but does that really mean that house prices will actually drop? There are of course a number of uncertainties to be addressed that play an additional role to the housing market. For instance, the US just recently entered a recession after seeing 2 consecutive quarters of shrinking GDP. Also, it's hard to say how each of these 3 metrics are weighted. Does rising wages and a low unemployment rate outweigh mortgage rates and a decrease in demand? Also, the US house price index is the highest it has ever been by a long shot. There might have been good reason for house prices to raise as they have in the past couple of years, but they might be in a bubble. Some of these factors are things that you must consider, but also things that you can't measure. We believe that house prices are set to decrease in the future, but wouldn't suggest planning on it if you need to buy a house soon. Here are a couple fun facts. Did you know that these were the top 10 appreciating cities when it comes to housing? Not only does Florida take 7 of the top 10 spots, it is also the fastest growing state in the nation with an annual appreciation of 29.8%. The number 1 fastest growing city, North Port Sarasota Bradenton, grew at a whopping 26.4% year over year, and 8.2% quarter over quarter. This means that if the house price was in line with the national average of $440,000 in the first quarter, that house would have appreciated an additional $36,000 in just 3 months in North Port Sarasota Bradenton. As far as the highest appreciating states, here are the top 5, and their average single-family home appreciation rates. Here's a chart of all states and their prospective gains. If you enjoy our content, don't forget to like this video and subscribe to our channel to stay up to date with market news. Thanks for watching and stay informed.